Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Hopefully everyone had a great holiday season and a happy new year. So we get to kick off the new year with some EIA data. I know you guys missed us last week, but we'll try to cover what happened a little bit last week. But really, the most important thing is going to be how did we close out the year and how are things setting up as we go into January and throughout January, given there is the Omicron issue and COVID in general, but realistically, when we're looking at the data sets, it's really not having the same type of impact as previous strains, which is a positive. And again, like we've been saying, that COVID is going to continue to weaken. It's going to get to a point where it'll just become one of the annoyances of either devolving or going to the point of the common cold or some type of flu. So when you and that's when we're looking at symptoms. So you're not seeing the same type of impact as we've seen with some of the other ones, but we are seeing it in the way of people not going back to the office. And I understand that people are using that as an excuse, as the reason not to go back, and it's a viable one. But I think as we continue on, and we've shown the different data sets, really highlighting that more and more people want that flexible schedule. And how is that going to structurally change where we see crude demanded and product demand? And one of the big situations that we continue to see here is, Mexico has been talking about they want to reduce exports, and it's more along the lines because they want to be self-sufficient. They don't want to have to worry about importing product, which would be a pain for the U.S. because when you look at the Mayan swap, which is bringing up Mayan crude from Mexico, and between the loss of Mayan crude, we've already lost Venezuela. PADD 3 is really going to struggle to find ways to bring in that heavy sour, especially again between Venezuela, Mexico, and as we know, the final kibosh, if you will, on the Keystone pipeline coming out of Canada. So there's a lot of things to really look at when we're considering where do we go from here as we come to the other side of COVID, as COVID starts to become something a bit more in the rearview mirror. And again, this is looking at the next 6-12 months. One of the things that we've really been talking about is that as we get past COVID, we're going to have more political more uprisings, more protests, and we saw it again in Kazakhstan. And that's not going to be the only one. And we wrote an article that we just re-released back in March, March of 2021, looking at what comes next and what happens next. And that's where we start, we remain concerned on what that global demand for crude will look like. And that's something that we want to really talk about right now when we're looking at where is demand going forward. And before we get into land storage totals, China cut crude oil import quotas, but they are also favoring the mega refiners. And this is something that we've been talking about through the end of last year when we had some new facilities coming on. China wants to get the smaller facilities, they want them to go away, which is why they increase scrutiny. Whenever they want to cut teapot run rates, that's one of the big things that they go after as well. Well, let's look if they're being compliant with taxes and quotas. And then shockingly, they're found to not be compliant. So when we look at how these allocations are going to work, this is really going to help push out or at least force some of these to close, and that will make more room for the state-owned refiners and the mega facilities that will have a bit more flexibility, especially when you consider that what makes them mega is the connection between both refining and petrochemical, so they can make really the best type of product or the one that's going to have the most value, whether that be gasoline or octane, or really turning it into something that might be high-density polyethylene or HDPE. So the allocations were shifted. Beijing granted 109 million tons of allowances to 42 private refiners in the first batch of 2022, and that it was an 11% less than the first tranche for this past year. But when you start looking at what does that mean, well, when we look at the fact that obviously we had the OPEC meeting, they've agreed to increase supply by another 400,000 barrels a day. But even though they're saying that, when you look at pricing, when you look at differentials, when you look at actual flows, we're not seeing the same type of demand in the physical market. And spot differentials of Russia's ESPO and Sokol, as well as Qatar's Al-Shaheen crude for February loading have slid by around $1 a barrel compared with last month. Remember, last month they were also down. So when you look at just where things are going, you're seeing some of this weakness. Angola hasn't sold 10 to 12 cargoes so far in January. That's a lot for this time of year. So when you look at these slowdowns, cargoes of ESPO were recently sold at the lowest level since August, while the premium of Abu Dhabi's Murbain crude has also slumped. So the pressure and again, there's the futures and there's the physical market. And the physical market, when you look at China cutting imports, you're seeing prices coming down because remember, ESPO, especially ESPO, was very favored into the Chinese market, even though they were taking in less imports. So this is going to shift who is buying, how much is being bought, and what is the competition going to look like in the physical market. But then when we consider how the land storage closed out the year, we closed out the year in a fairly positive spot when we go again around the world. The deficit widened from 43.4 million to 46.6 million, and a lot of that was driven by the west of Suez as the east of Suez kind of flatlined, and it's something that we think is going to continue to go higher, where west of Suez went from a deficit from 31.7 to 32.2. And then deficit narrowed a bit in east of Suez from 12.6 to 12.3. So that's one of the things when we look at where some of these shifts are, and we're going to talk about flows and how there is a significant amount of crude on the water, with a lot of it really going to really come into this land storage, which is why we talk so much about what is floating storage doing and where the delays, because China is still maintaining their zero tolerance policy for COVID, and that is impacting 3 ports. Well, one of them being the largest in the world, which again is going to impact how quickly we're going to see crude going from floating storage into land storage. And that's why we look at the floating storage side, which closed out at actually above 2021 levels, and right at where the highs were for 2016. So when we look at the surplus widened from 18.7 to 32.2. So that's why we always look at the two of them separately and then together to get an idea of what is the full picture of storage, both onshore and offshore. And one of the things that really created that was this West Africa and what has happened in floating storage on the west of Suez, because it went from a deficit of negative 7.3 million to a positive 600,000. And that's something that when we look at West Africa, that's where we think we're going to see additional builds, just given where the slowdown in that selling has been, because they're slated to sell, especially in Angola, slated to sell in January. They're probably going to load them, and that's something that may just sit, or they're going to have to try to find a price to try to move some of these assets. Then when we look at east of Suez, the surplus widened from 30.3 to 37.8. Because remember, one of the things that we were saying is as these cargoes go from floating storage, and so let's just use an example of West Africa, they go into transit, well, they're going to become floating storage somewhere else, especially when you have so many issues in terms of COVID and some of these delays as we're looking through the ports, which is going to put going from essentially floating storage from one, transit back into floating storage, which is why it's really that timing delay. Then when we wrap it up and put everything together, total oil and product stocks deficit widened from 30 to 60.4. And remember, this was not the previous week, but the week before. And you had a big move of product out of the system, especially in the U.S., with total crude stocks, land and floating. When deficit widened from negative 500,000 to negative 3.7. But it was really the products that resulted in this big move down, with the deficit widening from 29.4 to 56.7. Now we expect to see that start to reverse, which we did see in the EIA data. We had a crude draw of 2.14 million, but we had a gasoline build of 10 million barrels. We had a distillate build of 4.4 million barrels. So that's where you're going to start to see some of that reversal, and we expect to see it again in Europe as well as in Fujairah, which will start to adjust what the total oil products really looks like. U.S. weekly imports of gasoline from Europe were at a 5-week high. And this is what we were saying before we left for break, was that there was going to be this quick run up just because we had an increase in storage in Europe, and they were going to try to again balance that by pushing some additional into the market, which was going to end up in the U.S. just because even though we have had that build and a lot of that was done by Pad 1 still has a fairly robust pricing, which is going to attract. So that's why we did expect to see some of that coming through. And one of the other important things is China slashed its fuel export quota by more than half in the first batch of allocations for 2022, which it coming down to trying to manage some of these flows. A total of 13 million tons were issued, including both general trade and tolling issuance, according to officials. That's 56% less than 29.5 million tons in the same batch for 2021. On the back end, Saudi Aramco cut its January term contract prices for propane butane, which makes up LPG. Propane was set at $740 a ton, down from $795, while butane was cut to $710 from $750. So we're starting to see some of these shifts, while bookings for January loading of clean fuels from Asia to the Americas has started out fairly slow, with only one cargo, with December loading shipments remaining at that 305,000 tons. So again, this is where some of the movements are changing, some of the shifts are happening. We do expect to see European exports remaining fairly elevated, and elevated is relatively speaking, because right now when we look at where it is, it's still below the 5-year average, but we think that between 550, 600 will persist, especially given some of the builds that we're seeing in Europe. So crude stock draw, it drew by 2.14 million. That brings us 91.4 million below the 5-year average. And again, that was very much driven by Pad 2 and by Cushing. Pad 3, if you remember, they tried to kick out as much product as possible to try to limit that tax bill. Now that we're in a new year, we expect to see that reverse, and we'll see imports pick up, and we'll start to see builds ramp up within Pad 3, which will also limit some of the big spikes that we've seen in Cushing. And we're going to talk about what that looks like on a historical basis as we go through not only this section but also in segment 2. So here, when you look at Pad 2, there was a build of 2.25 million. Cushing had a build of 2.58 million. And as we had said, we thought we were going to close in Cushing right around 2019 levels. Instead, we closed right above it. But again, you're starting to see we're getting close to these normals. And again, that 5-year average is skewed based on obviously where 2020 closed out. Pad 3 had another draw of 3.47 million, brings us down 17.4 million below the 5-year average, and just below where, right around that 2019 level that we thought was the right target, with Pad 4 and Pad 5 fairly flat. Once we factor in the SPR, there was a draw of 3.49 million. We had a little bit of that extra that came out that were due to some swaps, and obviously the SPR sale, which, as we've said previously, takes an act of Congress. So that's something where you're going to continue to see the SPR drawn down, but and we'll show why, because when you look at the days of supply still remains elevated, even though we're seeing draws, because refinery utilization rates are still fairly reduced, and we've seen, again, hiccups and really new assets shutting down as we go through 2022 and into 2024. Production remained at 11.8 million barrels a day. Remember, our high end was 11.7. This is something that we're probably just above 11.7 at this point in time. We don't think we're quite at 11.8, but remember, there's a connection between the rig count, which has continued to be strong, as we've talked about with the frac spread really falling down along the seasonal norms that we typically see at this time of year. Now, when we look at runs increased by 10 basis points. As we go through into the first week or two of January, we'll get to about 91.5%. So when you look at just where the 5-year average is, we're 2.2% below the 5-year average, again, bringing us closer to that 92%. We think that we'll stay just below that, but we will see some activity ramp. There have been some issues with refiners that are going to keep them down, especially Baytown, which will cause a prolonged, and they're saying for months, running at a reduced rate, which will keep Pad 3 of a fairly capped as PADD 2 remains elevated. Now, when we look at imports dropped 874,000 barrels a day, with the lion's share of that being from PADD 3, which had a drop of 520,000 barrels a day, which was almost 2 million below the 5-year average, as we continue to see, again, PADD 3 trying to avoid. But now as we go into the first week of the year, we'll see this accelerate, and we do expect to see imports start to pick up. It won't be all at once. You still have to get the boats there. Floating storage has been drawn down. So we will see some of this, and pricing really wasn't advantageous for January. So that's why it's so important to see what our OSPs going to be coming out of Saudi Arabia, coming out of UAE and Kuwait as we go into February. PADD 5 had a drop of 386,000 barrels a day, still 71,000 barrels a day above the 5-year average. We think that stays elevated. So and then PADD 2, even though they had a drop of 133,000 barrels a day, you still are 539,000 above the 5-year average, because we do see a lot of imports still coming into PADD 2. So when we look at implied demand, as we were saying that we were going to get a big spike and then a big drop off, here is just putting that into terms. So we had a drop of 1.55 million barrels a day of demand. That brings us 293,000 barrels a day below the 5-year average. And when you look at where things are in general, gasoline had a drop of 1.55 million. The total was a drop of 2.55. So one of the things that we were talking about is that because of the issues in the shipping market and in the trucking market, we expected to see these massive spikes, a spike up and then a massive spike down, as a lot of this was going to be counted all at once, and then a drop off all at once. So we have gasoline coming 293,000 barrels a day below the 5-year average. And as we were saying, we expected to see to close out the year at about 3.8 million barrels a day of distillate, which is still 947,000 barrels a day above normal. Distillate is going to continue to be the bright spot, as we do think that gasoline remains a bit weaker, as well as jet fuel, as we go through the month of January. Jet dropped back to our target of about 1.5 million. And then propane remained strong, coming in at 1.745 million, which is just down by 1,000 barrels a day. Still 390,000 above the 5-year average, and remaining as robust as we were expecting. Now, when we look at crude builds, we were thinking we were going to close out by closer to the 2919 level. Instead, we followed a fairly similar decline to 2017 when you look at just the slope. Now, it's something that we do expect to see, an increase in storage as we go through the first 2 weeks of January. And then the question would be, how quickly do we see this, and where do products go? Because we typically come into a bit of a build period at this point in time. But while all this is happening, you can see that the days of supply for crude oil remains elevated. It's right below where it was back in 2015, and it's still above where we were in 2019. So this is something that, again, we'll see this remain fairly flat, fairly stable, but we will see some a decent amount of increases. But the question is going to be, how fast does oil rise versus how fast does refinery utilizations rise? And that's going to dictate really where the days of supply can shake out. But we just think it's going to be fairly steady in this region, because as refiners come back, we will have new imports coming through. So when we look at everything, including oil and products, you see the little bit of a spike. As we were saying, we expected this to just flatline, and here we are. We're right. We didn't really do much up or down. We had some big weeks up, big weeks down, which again averages out to something fairly stable when we look at what has happened in general. And as the headlines come out, Marathon, Galveston Bay shut crude unit Thursday, and these are some of those little things that we're seeing. These little shakeups within PADD 3 that will continue to keep things fairly flat when you're looking at refinery run rates. Then when we look at gasoline had that big spike of about 10 million barrels. You can see we were expected it to close right at the 2019, right near the, not the 2019 levels, I apologize, the 2017 levels. We were right there. we had kind of this normal spike that we get. Now the question is going to be, what does it look like as we start the year? And we typically will start right around this level. Distillate also had that normal kind of year-end spike. Obviously, was much less than the others, and that's something that we think is going to continue to happen over time. Well, we'll get a fairly steady increase, but it's going to take. It's not going to be very quick because demand remains so strong, and we are going to see heating oil demand increase, especially in the Northeast, as we go through the next 2 weeks and the weather gets a bit cooler than normal. Jet remains depressed in terms of storage, and this is just, again, that back and forth between what is in Disti and then what is in the kerosene pool. Now the crude curve, you had a nice bounce pretty much across the whole curve in general. This has now put us well above where we were for above 70 as we go through pretty much all of 2022 into 2023. And then things remain robust and above 65 through 2024. And that's why when you saw this drop down, people were talking about, oh, well, this is going to impact investment. It's really not, because when you look at where the curve goes, they're taking long-term projections, and you're going to have movements, especially in the middle, like, let's say the front end and the front middle part of the curve is going to move fairly rapidly. So it's going to have to be a very sustained move lower to see that really shift, because there are decline curves that have to be addressed. There is a boost in investment that we've seen over the last 3 years that is finally kind of coming to the tape, that will help alleviate some of this. And here's why: because there is money to be made in 2023 and 2024. At this point in time, the question is going to be, how quickly can they access it in terms of trying to capture where things are, because we still remain in backwardation. Now, as we've talked about with COVID, we've had a big spike. Just anecdotally speaking, I know more people with COVID or that have had COVID this round than who haven't. It's spread like wildfire. People have ranged with a 72-hour mild flu to bad cold to either no or minor symptoms. So that is a positive in terms of it losing some damage when you're thinking about how it's impacting health. It's still something to not take lightly. Obviously comorbidities are all very, very important when considering, how much risk to take, if you will, or how much to risk exposure. You can see that we've are starting to come to to kind of the peak. I know France put in a new high. The U.S. is struggling with testing and availability. 31 local testing facilities had to shut down due to lack of staff and tests. So again, the assumption is that it is a bit higher. We are starting to see this creep up in Asia now. We do expect to see Asian numbers to go up after seeing what's happened in Europe and the U.S. So that will also kind of impact some of the demand that we're going to see or expected to see in the emerging markets. So then when we look at PADD 3 crude, we were expecting to close right around 2019 levels, and we were closed just above, but again, very stable. And then we will see some of that increase as we go through the first 2 weeks of the year. Cushing, as we were saying, we thought we were going to end right around this 2019 level. Instead, we were just above. But when you look at it against other periods of time, including 2011, when we look at 2018, the slope is very much in line, and it's something that is going to close out the year. Still below the average, still in a fairly bullish position, but it's a gap that we do think will continue to close as we go into January. But the comps also get a bit easier, which is going to help. Again, what does this look like against the 5-year average as these additional flows come down from Canada and end up in Cushing? Floating storage had a big drop. We expect to see this rebound, not to the 5-year average, but again, staying within the lower end of that cloud. And then when we look at imports into PADD 3, had that big drop off. We do expect this to rebound and fall within the lower band, really bumping along the bottom. Really not getting back to the 5-year average anywhere close. but it's getting within the cloud, but still very much along the bottom, while PADD 2 still continues to set new records. And this is something that we expect this to remain. And when we look at 2022, we expect 2022 to be a record year of imports into PADD 2. And it's just because of you can see how 2021 ended is how all of 2022 is going to go, given the new pipeline that has opened, which again is going to enable more crude to come down into this region. And now wrapping it up, when we look at refinery utilization rates, as we were saying, we were going to close out the year just below that 29-year average, and we just expect it to be just below, but starting to close that gap a bit as we go into the first 2 weeks of January. And now that we've covered kind of the overview, we're going to go a bit deeper into demand and U.S. products and what is happening within the United States as we ended fairly strong in 2021, and then what does 2022 hold for us?